Guys, if you're a beginner trader, I want you to watch this video to the end. So today I want to just show you how to take trades correctly. Then I'll also take you to my chart to show you examples on how to trade. But I want to also tell you that this is not like 100% guarantee, but it works most of the time. So the first thing here, you can see that on this my schematic diagram, I have my liquidity drawn out. So before you even start trading, the first thing you're supposed to do is to know your targets. And by knowing your targets, you have to think about what is going to drive you down to your targets. And the only thing that can drive you down to your targets are liquidities. Liquidities are like the whole fuel of the market. These are what push prices from a particular level to another level. Notice how the price is actually moving after a particular sweep of liquidity. Just this inducement is a type of liquidity, so there are different types of liquidity. And if you don't know how to identify liquidity, I also have a playlist where I talked about the types and how to identify them. So I want to show you something before we go to our chart. Notice that for every liquidity we take out, there's also a opposite retracement. Just like this low is below the low here. We have old order. Like this liquidity are in forms of money. Then they are in forms of money, and this money can come into the market by, you have them like running positions. We have orders that are pending order. Let's just say there's a block order around there, and most of their stop losses, which are money, are below here. So as soon as price trade into this level, it's going to tag this order and trigger all the stop losses, making them lose their position before going to their favor. So because trading is a win and loss game, before one other person have to win, somebody have to lose for one person to win. So these people that have lost around here are the one that are going to get these people paid. So since it's even a loss game, one person have to win while the other lost. So that's why most people get stopped out and some people are left out. But that does not mean you're not going to use your stop loss, because you're always mitigating, because your price always gets stopped out. Stop loss is also good as a beginner trader. It helps you reduce the risks or the chance of blowing your account. So like I said, for every sweep of liquidity, there's always a retracement. So with time as a beginner trader, you have to understand or be able to identify a real sweep of liquidity. That's why you really need to go to my playlist to watch out these videos where I explained the difference between sweep of liquidity and run on liquidity. But for now, just notice that liquidity is what moves price action. So you can see how price was trying to trade down to this level, but until price took out liquidity from the previous high here, we gave rise to this impulsive price action. But because you're a beginner trader, you want to be trading from two places. You want to be trading from two places. The first place is a point of liquidity, and the second place is that you're trading to another point of liquidity. These are the surest places that price can go to. So if you're trading after this inducement, you want to be trading to this level of liquidity. So you don't have to trade blindly. Just know your targets as a trader. Just like here now, we know that we are trading from a particular level of liquidity. Liquidity has been taken below this low, and we have our confirmation. So we are trading from this inducement. From this inducement, we're also targeting this double high here. So this is like a bonus tip, guys. So whenever you see price action forming several highs, you can call it several resistance or support. Just know that these are the places that have high level of liquidity, and price is going to come there more often to take out liquidity. So you have to firstly know where you're trading from. Price has taken out this inducement. You can see this whole impulsive move down to the next level of liquidity, which are these double highs. Then after the grab of liquidity around this double high, you can also scalp a little to your desired level. Then you see price this is the reaction from the liquidity, which you can scalp here, short sell. Then after a sweep of liquidity above this high again, you can see that there's a retracement down to this level of liquidity, which is this inducement, giving rise to this buy, this overall buy here, this buy you're seeing. So you can see, just like that, we just trade with liquidity. So before you can even trade, the first thing you do as a beginner trader is to look for your entries. And there are two things your entries must have. Your entry should be able to give you exit, and your exit should be having a liquidity that is attracting price to your exit point. Let me come again. Your entry must have a liquidity that's going to drive your price to your exit, and your exit must also have a liquidity that is attracting price. This is your entry, and you've taken out liquidity, and this is your exit level. It is attracting price towards you. Then if you look at here again, your entry taking out this inducement, and it has this double top here attracting price towards itself. That's why if you look at here, there is no clear liquidity that's attracting this price. That's why you see we did not have a very good price action here. I hope you understand it. But we just had liquidity that drop, that price took out, then retrace a little bit. But there's no liquidity calling it around here. That's why you not see a good price action delivery here. But if you look at this one had a liquidity, you can see the impulsive movement just like that. Then after we took out liquidity above this high here, you can see that this low now stands as a good exit point. So we've taken out liquidity that's going to push price downwards. Then we have another liquidity that's drawing price towards itself. That's just the difference between this entry and this entry, and you can see that this price action played out more um perfectly than this other one. Then you look at here, this low now stands as an inducement to give you a entry, and this high also is now your exit point. So just follow that same scenario or sequence there. So let me just take you to the real chart where we have then our liquidity, or where I have some examples. So before I go to the real chart, I want to say something. I'm not expecting you to really understand it now, but with time, if you think about it, you're going to understand it. Just like we have different time frames around here, we also have different forms of liquidity around this time frame. We have the 1 minute, 2 minutes, 3 minutes, 5 minutes, 10 minutes, 15 down to 4 hours, like that. So let's just say to the monthly time frame. Then in all these time frames, they are existing liquidity. Yes, because we have to trade in all the time frame, or because we have traders in all the time frame. So we have 5 minutes, we have liquidity on 5 minutes. Any time frame you go to, you're going to see your liquidity. So because we have numerous liquidity, we want to also trade from a level which is really significant and important, that's going to drop the price. That's why we'll focus a little bit on time frames higher from, or time frames above the 15 minutes. Now because the 15 minutes is actually a medium time, I think we can actually make something up from the 15 minutes when we sweep liquidity. You cannot compare price action or price delivery with the 1 minute liquidity to the 15 minute liquidity. Now let me say something. The higher you go in price, the higher you go in price or time frame to seek out liquidity, the more delivery of price you're expecting. Let me say this. Let me go, or let me just show you in the chart. Assuming you're trading a 1 minute chart like this, a 1 minute chart, a downtrend, and you have this to be an inducement, and price came back to take out liquidity above the inducement, and you short this market. Yeah, this is what I mean. So you might be shorting from here to this down point. So let's just say this is a 1 minute chart and we sold from this particular inducement. So you already know what an inducement is. This range within this level, this old high, we sold from this level here on a 1 minute chart. So let's just say we make up to this low here. You are not going to get a, should I call it, much profit here, because this is a short run in price action and it's going to cover little piece because you're trading from the 1 minute time frame. But looking at this in a 1 hour time frame, we are going to cover up. If we calculate this range from here to this level of liquidity, you might be having up to 500 pips. Why, if you're trading on a 1 minute time frame from liquidity, you might be having here as just 100 pips. That is why you have to also use the higher time frame to identify your liquidity levels so that you can earn more while trading. And on 1 minute time frame, there are numerous price action happening on the 1 minute, because it's from the 1 minute you get to view what is happening in the market. You cannot compare the movement of a 1 minute time frame to a 1 hour time frame. So you have numerous liquidity because all the time frames are going to be running in a different in order to bring you to a particular view on the higher time frame. Just like you know that the smaller time frame makes up a higher time frame, so you're going to see a lot of price action that's making out or making up 1 hour candlestick or 1 hour price action. So it will be too many candlesticks on that area, and for every candlestick you have different kinds of liquidity. I don't expect you to understand what I'm saying, but just try to grab what I'm saying. How combining liquidities and time frame now. Combining liquidities to time frame. When you sweep a liquidity from a higher time frame perspective, you tend to get a higher time frame delivery or you tend to get a larger delivery. So if you're using a higher time frame, you tend to cover a higher range. So let's just say this is a weekly chart and the weekly time frame. If you're taking out liquidity from the weekly time frame, it's gonna take you about 5 weeks to cover to this range here, which is this low. And in 5 weeks you have about how many days? Up to 20 days. So imagine trading for 20 days in a particular direction. You're going to actually make more profit. You're going to make more profit than you make in a day. So you're already trading for 20 days in this particular level, you're going to make more profit down to this level. Then imagine this to be a daily time frame. So if this is a daily time frame, you are going to be trading for about 24 hours. So imagine trading for 24 hours. Yes, you will be profitable, but not as much as the one you're trading with from the weekly time frame. So you have a sweep of liquidity, and for 24 hours you're moving in one direction, which is actually going to be nice. Although the market does not run completely 24 hours, but for you to be in this direction in one day, it's going to be a very good price action, and you'll be looking at 400 to about 500 pips. Then if you're trading this level in weekly time frame, you'll be looking at about 2000 to 3000 pips, because this range will be larger in a weekly time frame. So imagine you're also trading here in a hourly time frame, like 4 hour or 1 hour. Let's just call it 4 hours. So 4 hours you can be doing up to 400 pips at most if it's a good pair. Then imagine you're trading here from 15 minutes. Now you have a liquidity sweep from 15 minutes, so you'll be catching, or this range can actually give you at most 300 pips or 250 pips. At most 300 pips or 250 pips. That's if it's still good, it's 300 pips. So imagine you're trading from the minutes time frame, 15 minutes, 20 minutes or 30 minutes. You can just cover up to 30 minutes, 300 pips or 350 pips. What am I trying to say is, whenever you're reducing in time frames to trade, you reduce the range you cover in pips. Yeah, because you use pips to calculate a particular range. So that's it. So it will be important that you look for your liquidity sweep from weekly time frame. Now the weekly time frame, now, because you know that whenever you have a sweep of liquidity, you expect a retracement, right? So this retracement can take, if this is a weekly time frame, this retracement can take up to 2 weeks to complete retrace to this level. So imagine you enter a market here. Even if you enter a market here from a daily time frame, using the liquidity sweep of the weekly time frame as an idea, you have up to 2 weeks to trade down to this level. And if you first take the trade on a, maybe the first day which the liquidity sweep occur, you can you have an advantage of for like 2 days trade, like 2 days free trade on that pair, because the first 2 days is going to be giving you this short retracement, and you have that advantage. So the higher the level of liquidity you seek for, is the more advantage you have in that market. So that's it. Let me show you this one I'm actually on. This is USD JPY I took last week. I want to show you something, guys. Now if you see on the weekly time frame, there's a sweep of liquidity here on the weekly time frame. Now I told you liquidity can be found in lows and highs. So let me take these ones out. This is me showing you the real life chart examples. So if you attack the liquidity from a higher point of time frame, you tend to get advantage. Like I told you, 2 days advantage at most. So see this. See what happened here. This is a sweep, this is a weekly time frame, and I told you liquidities are found around the lows. So after this sweep of liquidity below this low on the weekly time frame, I told you that as I've identified this liquidity from the weekly time frame, I have about 2 to 3 days to give me that shock. Now on the weekly time frame, you're just seeing one candlestick giving you this retracement. This is just one candlestick giving up this retracement. But if I should go down to the daily time frame, I have about 3 to 2 days to trade in this direction. That's the advantage of seeking liquidity from a higher time frame. Yes, I'll also show you on the lower time frame. So from these 3 to 2 days, I will cover up more price action. That's what I was trying to explain in just um um that's what I was trying to explain here, that if you seek out liquidity from the higher time frame, you tend to cover more range. So this is it here. I will go to the daily time frame. So the daily time frame, let's just say you have this sweep of liquidity, and this is where I could find my entry here. And you can see this is like 2 days. 2 days actually went in direction. 2 days actually went in this direction. So you can see you have 2 days to trade, and for these 2 days now, you see, let us see how many pips we were able to gather. So let's see how many pips we were able to gather using this range calculator. So I'll reduce it to the 1 hour so we can calculate this range. So this is it here. If you want to calculate the range, you just come to this price range. We were able to get at most how many pips. You see, you can see what I'm saying, up to 150 here is about 1500, because this is USDJPY, you can see. So this is about 1000 pips. 1000 pips, that's a whole lot. So imagine we actually, and you see, just like I said, I exited this market at this level of liquidity also. So you must have a liquidity at your entry and a liquidity at your exit. This old high was my exit level, where you can see how price is reducing or dropping or retracing, anyhow you want to call it, retracing after the sweep of liquidity above here. That's what I'm saying. That's what I've been trying to explain. So you must have a liquidity as your targeted exit point and a liquidity as your entry level. So this, any other thing here is for the advanced. I'm just trying to teach you how to enter. So even if you entered right up after the shift of the sweep of liquidity, you will cover more. But due to the fact that you cannot be in the market always and you need confirmation, you might not really enter at this level, which is this immediate sweep of liquidity. So let me see if I have other trades I've taken here on USDJPY that has to do with liquidity sweep and the rest of them. During the course of filming about liquidity, I saw one example I was going to chip in, but the trade was not ready. And when I came back to 15 minutes, I saw this example, and you can see right here, this is synthetic. So because this is weekend, I'm doing this example. This is synthetic, and you can see that I have a liquidity sweep here on the 15 minutes. Guess where my target is? This other liquidity. This other liquidity, and you can see we are almost at take profit just right now. Same day I'm doing this whole liquidity lecture, I just noticed one of my sweep of liquidity. Now let me just chip in this last bonus. I was supposed to have my stop loss right above this liquidity, but that's already much, and I don't want to do one because this is $9 to $16, and there's something called liquidity void, which I saw on the 15 minutes here. We should zoom in. See this fair value gap here. See this fair value gap here. So I just know that if actually this trade is going to hold, we are going to trade from this liquidity void, this fair value gap. So if we trade into this fair value gap completely, then we want to keep on shorting. So I had my stop loss right above here, which is about $2. Yes, about $3. So this is almost 1 is to 3 times 1 is to 5. Yeah, 1 is to 5, and you can see just this sweep of liquidity. We have confirmation is the shift in market structure. Let me show you. So that's what I always use for my confirmation of entry. Where is the confirmation? The shift in market structure, which is this price breaking this last low to tell you that we are about to change structure with an impulsive move. And when I saw this impulsive move, I quickly entered this trade, guys. I quickly entered this trade. If you're looking at the history, it's something I just took instantly, because I was actually filming this or recording the whole concept of liquidity, and just while recording, I was looking for trades. Sorry, chart I was going to explain here with on MT5, and I just saw that trade. This is trade history. I just met this trade, and I see, yes, this is the perfect thing I'm teaching. Why not take the trade? So I just took this trade, and that is it, guys. So I'll be closing because price do dance around liquidity, although it's in to take out this liquidity. So I'll be closing this trade right now. So just like you can see here, this one was what I took last week, and just like that, I was able to gather up to 1000 pips because I understood the importance of identifying liquidity sweep from a higher time frame perspective. So if you want to even identify a liquidity from a lower time frame, it's not really going to give much, because here is the lower time frame, and you must also have your exit point also. So this is another trade here, although this one went south. This is the type of liquidity I've been trying to explain. This double top, this trade did not hold, so I lost this one, this particular one. This trade did not hold. Now look at this one. Let me show you something. Let's go back to the daily time frame or the weekly time frame around here. This is what I was trying to explain to you. When you identify a weekly time frame liquidity from, you're going to actually run in price. Now I know that this market is bearish and I have this good high to be liquidity. That's it. Because I was able to identify the liquidity from this weekly time frame, I had to go down to daily time frame, and you can see because I'm actually identifying the liquidity and also following that trend, we actually moved well. You can see how many days in profit, or how many days do we use to go down to that level, about 2 weeks, which is about 10 to 14 days. And you can see I was targeting the next strong liquidity, which is this level here. So trading from one level of liquidity to another level of liquidity, which is very very good. Although I did not stay for 2 weeks in this trade, I actually went out on the third day. So this other one you can see on just on the daily time frame. This one, let me just use the daily time frame. This one you can see on the daily time frame. After I sweep for liquidity below the daily time frame, I had my confirmation and I traded to the next level of liquidity, which was this high. Just like that, guys. Let me show you other pairs. So see, this one was one of the trades I missed this week. So if you go to the 4 hour time frame or the 2 hour time frame, let me show you from the 2 hour time frame. This trade slipped off my hand because I was actually looking at this double top here as a liquidity, then more like a breaker block, and I had my liquidity that was going to push price down and liquidity that I was targeting. Now you can see how price dropped massively but did not really come back to my level of interest. I didn't know why, or okay, I later found out why. I was actually trading from a very wrong point of interest because I was looking at it from this level. Meanwhile, price had moved on long ago and I was still hoping. I was still hoping, so it was my own mistake and I tend to correct myself next time. Let me show you. Okay, EDHF. This is a sweep of liquidity here, right here. From a very, see, sweep of liquidity, and I was able to catch this trade here. This is another sweep of liquidity and I'm targeting this liquidity. Although this low is also a liquidity, but just have a liquidity for your entry and a liquidity to your target. So these are the two things that will draw price to you. So you see here, did I take any trade here? So see this one is not really visible. Let me check other pairs also. Cat CHF. Let me go to like 1 hour so I can show you also. So these are practical examples. These are trades I do take. So it's not something that I'm just coming to tell you. So like I told you, I explained something. When you're actually trading and you don't have a liquidity to exit from, yeah, you might not really get a full or a good price action. That's it, yeah. So this was the liquidity I traded into, like this high, and you can see this high here, price swept this high from a daily time frame. And just because there was no closed liquidity around this level, I had to exit on time. So this one swept liquidity this low. You can see liquidity is below here that is swept and we pushed up to that trade. This one also you can see this liquidity below here and we also moved to take profit, which was having this targeted liquidity also. So there are many trades I do take. Some days we lose, some days we normally win, but just focus on what you have to focus on, which are liquidity. You can see this was the liquidity void I traded from, which actually I was targeting this liquidity as the immediate exit level before going for this overall liquidity. If you look at here, I was trying to trade from here, this level, to this exit liquidity, to this low, to this long-term liquidity, but I could not really get it from there. But the second time I actually got it, which was here. So with time, price is going to retrace to a very old level of liquidity. That's just it. You just want to have liquidity before your trade and after your trade. So there are many types of liquidity. Just in case you are not seeing a clear view of me taking out liquidity, just know that liquidities are in different form. So you just need to actually know the kind of liquidity I'm also trading from. Now this is what I mean, that this whole strategy or this whole concept does not work all the time. So this is a sweep of liquidity here. This is a very sweep of liquidity. You can see price only pushed a little, but I got stopped out real time. and also this one too, I got stopped out twice. So most times liquidity does not work all the time. Price might be seeking for more liquidity before the push, just like price broke, took out liquidity here. And let me take this out. So this is what I mean, that price might be seeking for more liquidity. Price took out this liquidity from this low, and it gave me this rejection. So I thought I had my confirmation around here, and I entered a little bit and I got stopped out. And until price took out this low, it gave us this whole rise. Now let me kind of go to the 15-minute time frame, let you see what I'm saying. So after that sweep of liquidity around here, after the sweep of liquidity around here, I had my confirmation. And when I entered this market, price was just so reluctant. But if you see what happened, price actually was seeking for more liquidity, which was this low now, which was this low. So as price took out this low, it actually gave another confirmation, which I had already left the market. And if you see, that was when price actually um gave this whole price action here. So down to my targeted level, we had the whole price action, but me, I already got stopped out. Already got stopped out. Already got stopped out. Now, just like this level again, you can see that price took me out here after it must have cleared liquidity here. Before it cleared this liquidity, although this was where my stop loss was, so price took me out here. And if you notice, I was actually trading from this level of liquidity. So this was the level of liquidity I traded from, thinking that price must have taken out this liquidity here. So two times I lost this market because of price seeking for more liquidity. So this is example of price seeking for more liquidities, and you can actually fall for that. And it's okay because you've actually played your own part. So I traded from this level here, thinking that price has swept liquidity just like that. I had on my confirmation shift in market structure, and yeah, see how price went back to take out price. So most times it won't, and sometimes price might just want to seek for more liquidity and get you stopped out. So that's just it, guys. This is where I'm going to end this video. So if you have any question on how to identify liquidity, you can ask me. I already did a video on that. So what you just need to know is that as a trader, for every entry you must have a liquidity, and for every exit you must also have a liquidity. Now everything here are actually playing out well. If you look at it, after I got stopped out, price actually came back to my targeted liquidity this low and gave you that retracement, that reaction I told you, because for every sweep of liquidity there's always a reaction. Look at this sweep of liquidity, look at the reaction, and I thought we were already going to go down to this liquidity, and just right from this level, if you notice all this kind of consolidation in the market, just know that price is seeking for more liquidity. There is not enough liquidity to drop price down. That is what just happened in this trade. So like I told you, sometimes we do make losses, sometimes we do win more trades. So that will be all. And if you see this one also, there are many losses, but the most important thing as a trader is let your win be much than the losses. So that will be all on this concept. Even here you can see that there's a sweep of liquidity right above here, but we had the confirmation and everything, but price did not deliver as planned. So I told you, most times we do work, and sometimes it doesn't work out that way.